Alibaba has become a beloved stock by many retail investors, including many of your favorite YouTubers and even prolific investors such as Charlie Munger. Most agree Alibaba looks like a very good value, but there are some risks such as the regulation and the VIE structure. Well, I'm going to expose the dirty truth that they are undoubtedly the Chinese Enron. Every discounted cash flow and stock analysis you see on Alibaba is completely wrong, as Alibaba uses complex accounting practices to hide losses and instead show large income gains that are completely non-existent. In fact, the company is losing tons of money, and the majority of people don't even see it. In my opinion, Alibaba's entire purpose is to fleece foreign investors out of billions, funneling this money back into China and the founders of the company. You're going to want to watch this video in its entirety, because once you do, this will all become very clear. And remember to like, share, and subscribe to get this information out there. A full disclaimer though, these accounting practices are technically legal, just like Enron's accounting practices were legal as well, but they are designed to heavily distort the real numbers and present you a picture of the company that does not actually exist. And back in 2016, there was criticism for these exact counting techniques, but it was happening at a much smaller scale than it's grown to today. So I'm going to go into the financials now, which some parts may get complex, but I will try to simplify it as much as possible to explain the core concept, and by the end of this video, you will at least have a good understanding of what's really going on with Alibaba. So when we first dive into the accounting, the first thing that caught me as very strange was their interest and investment income. As you can see, their interest and investment income makes up a very large portion of their net income, especially in compared to their income from operations. So you see from years of say 2019, 2020, and 2021, we have 6.5 billion, 10 billion, and $11 billion. And you might wonder, well, where is this money coming from? And this is exactly what I thought. Most people, when they see the interest and investment income, they assume, oh, well, Alibaba has investments such as, bonds or something else that's yielding them some cash flow and that money's coming into them, or they sold some investments and made some profits. Well, we're going to figure out where this is coming from by going to Alibaba's investor relations and looking at the statements from the company. So I've taken a few snapshots from Alibaba's quarterly financial results. And this money is accounted for in their interest and investment income net. And we're going to see a recurring pattern that's happening. So $1.5 billion, a net gain arising from the fair value of our equity investments. $2.8 billion net gain arising from the change in fair value of listed equity investments, and non-cash gain of $870 million. $2.9 billion, a net gain arising from the fair value of equity investments. So the first thing you should realize is these are fair value adjustments, and there is no actual cash coming into the company or any cash transaction happens. And they can do this because what is referred to as the equity method of accounting, when they have ownership of 20 to 50% of a company. So as we can see on their income statements here, there is a very large portion of this fake income. And when we total it all up, in the entirety, even accounting for the 1 year they did the write-down in 2022, there's been about a $41 billion gain in net investment income compared to the total net income, where there has only been $105 billion in net income. So almost 40% of all their net income has come from these non-cash fair value adjustments. This is not real cash coming into the company. These are just fair value adjustments. So let's look at Alibaba's investments now. And this starts getting into what exactly is the whole business structure of Alibaba. So their capital expenditures, which is actual within the core Alibaba business, the money they've spent to invest in it, is $31 billion compared to the acquisitions, which is actually when they put businesses, acquire over 50% of them, it's been $50 billion. And these other investments is $64 billion. So you can see Alibaba's primarily investing all their money into these other investments and acquisitions. And this is how Alibaba works as a business. Alibaba effectively builds all their different business segments originally off these off-balance sheet entities and records them as investments and books these investment incomes along the way. This is not how a regular business financials are done, or they account for their businesses. Regular businesses, all their business segments are typically included in their normal operations, so we can see all the profit and losses and the breakdowns of them. And you can't make these imaginary investment income gains along the way as well. So this really helps give the illusion of that they have free cash flow and profits. So when you actually look at their net income from continuing operations, this fake net operating income that we talked about is included in it. So we're going to break this down a little bit to see how much money Alibaba is bringing in. So they had a total of 163 billion of cash flow from operations. There's been 31 billion dollars in capital expenditures. There's been 41 billion dollars of this fake investment income that doesn't actually exist. There's also been 33 billion of stock-based compensation. Those insiders at Alibaba have been paid very, very well. And there's been 64 billion of investments. So because a lot of these investments and other stock-based compensation as fake investment income should be actually taken off the cash flow of operations accounting for Alibaba's business model. We come to the realization that even at this, before their acquisitions, they've lost $6 billion. So the company is definitely not profitable at all when you account for the weird structure of Alibaba. So just to get into how a traditional company structure works is you'll have an entity such as Amazon, and they'll have their Amazon delivery, their Amazon Prime Video, their AWS Cloud, various other operations, and their e-commerce retail segment. Some of these may make money, some of these may lose money, but all of these are reported in the financial statements, and we get to see everything from these operations. Well, Alibaba's company structure is completely different. This is a very simplified down chart to try to explain how this works. So basically there is the core operations of Alibaba, which they do have, and then there's primarily two different ways they account for their business segments. There's the ones they have over 50% ownership in, which are consolidated in the financial statements, and the ones they only have 20 to 50% ownership in, which they get to use this equity method of accounting and readjust their income gains based on the fair value. So with further consolidated ones, they may own various percentages of these as well. They actually don't own 100% of all of them. And the interesting thing is under the consolidated method of accounting, a parent company combines its own revenue with 100% of the revenue of its subsidy. And this is even, or the subsidiary. This is even if they only own 51% of it. So when you're seeing their top line revenue, this could be grossly overstated because of this accounting method. Although there is an adjustment that does happen near the bottom of the income statement for the minority interest of the other entities that own these. Most people don't see this, and it completely distorts when you're looking at Alibaba's top line revenue growth. And just to kind of get into actually exactly how more complex this is this is from a little clip from a Forbes article in 2016. So they say this includes approximately 40 subsidiaries and consolidated entities incorporated in China and approximately 80 subsidiaries incorporated in other jurisdictions that are not illustrated in the chart. The chart referring to the traditional breakdown Alibaba gives you of all their different entities they own in the business segments. In addition, the entities pictured in the chart hold, directly and indirectly, an aggregate of approximately 100 additional subsidiaries and consolidated entities incorporated in China and approximately 90 additional subsidiaries incorporated outside China, not in the picture chart. So this starts to paint a very interesting picture. First of all, this was back in 2016, so by now in 2022, this number could have grown to thousands of different entities. But all these different entities, Alibaba has various parts of ownership. These entities themselves also own a bunch of entities. And as we've learned, using this equity method based on fair value, they could effectively book fake income as well. And we don't know entirely because for the ones with 20 to 50% ownership, we don't get to see anything on their books. We just get to see the net income they record, which very well could be manipulated. So to give a past example of how this has worked. So this is from Q1 of 2016. So their interest in investment income was 4.4 billion. And this arose from the deconsolidation of Alibaba Pictures. So Alibaba Pictures was consolidated, and then it became deconsolidated when Alibaba was diluted from a 59.4% ownership to a very convenient 49.5% ownership. And they were able to recognize this $4.4 billion gain based on this new investment in the company. So this is very, very funny for several reasons. Is Alibaba Pictures, the only reason it would likely need a new investment of money is because they were losing money. And Alibaba was able to actually book a $4.4 billion gain in the process of this. And also very convenient that 49.5%. This just brings Alibaba under the level where they have to consolidate Alibaba Pictures in their financial statements compared to where they can use the equity method and effectively have it as an off-balance sheet entity. And this gets into this point. These other investors are here for the purpose of Alibaba to let them move these entities into different accounting practices and also book these fake gains around the way. So for a hypothetical example of just kind of how this works is Alibaba invests $1 billion for a 59.4% stake in a company. Using this valuation, the company's value is $1.68 billion. Now another anonymous entity invests $1.8 billion for a 20% stake at a later date. Well, based on this new round of funding, the company value is now $9 billion. So the company value has increased 5.4 times, and Baba has been able to record a $4.4 billion gain of investment income. That didn't actually happen. So this gets into how Alibaba's business segments actually work, all the little parts of their business. They create these new companies with approximately the 20 to 50% ownership. They fund the operations of these companies through the purchase of investment. And this is what we can see on the cash flow statement. But then this does not affect the free cash flow. And then they can continue to invest directly, or other companies can invest to grow these new business segments. And they can record investment income on their income statement as these investments reevaluate the company themselves, even if these companies themselves are losing money. And these entities can be doing these exact same accounting tricks as well, or maybe they just lie. As we know from the past, many smaller Chinese companies just have flat out lied about their financials or faked them. So an example of just showing this is how Alibaba's business segments actually work is Canino is effectively Alibaba's logistics arm of the company. I forget exactly the exact ownership now, but I think they're in some around the 60 to 70% while. But you can see back in ownership, but you can see back in 2013, it was originally founded by Alibaba Group and 8 other companies. And then by 2017, Alibaba again just gets over that 50% for the 51% stake. So this is just the core of Alibaba. They are a black box business model. Everything they don't want you to see is hidden from plain sight. Much of their income is fake income from these fair value adjustments. Alibaba is not actually just Alibaba, but a web of hundreds to thousands of other entities, which all own other entities themselves. And there is no accounting for any of these off-balance sheet entities. There's no disclosure for the insider share selling, which, as we know, the insiders have been handsomely rewarded with $33 billion of stock-based compensation. There's no disclosure of insider interests in these other entities. There's no disclosure of the other investors in all these other Alibaba businesses. We don't actually even have disclosure of what all the different entities Alibaba has interest in. And there's no disclosure of the relationships Alibaba has with these other investors. So just this comes down to Alibaba is effectively the Chinese Enron. I hope you've enjoyed my presentation and analysis on Alibaba. I have tried to simplify down much of these complex accounting practices to the core elements that affect what we see on their balance sheets. Although there are more complexities to how this accounting works themselves, it would make this presentation way too long, and effectively I'm still getting down to what the core elements are. So I hope you like, share, and subscribe, because this is my first video, and if you would like more content like this, feel free to ask me to cover any other topics in the comments, and if you have any questions, you can ask them as well.